All right, mortgage basics. That is what we are talking about in this video, a broad overview of what a mortgage is. I assume if you click on the thumbnail, you are a first-time home buyer, probably just starting the process, or maybe you're in the middle of the process and you just have questions about what a mortgage is. However, it's not only for you. It's really for any homeowner or anyone who has a mortgage. In my experience, it doesn't matter if it's your first home, your second, or your third home, but you're working with professionals, real estate agents, insurance agents, settlement companies, and even your loan officer like me who help people buy homes every day, or at least we have conversations with people who are looking to buy a home. And in those conversations, often the basics just get overlooked. We just assume you know the basics. Well, I'm gonna make the assumption that you don't know the basics in this video, and we are going to dive in. Mortgage Basics 101. If you're new here, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C., and the purpose of this channel is to help you manage your mortgage and finance your real estate goals. So I would suggest you subscribe to this channel because we've got a lot of great content coming out, and I would also suggest you hit that notification bell so you're getting timely updates to seeing what's happening in our industry and in your market. So I am going to just dive in, and if you have questions after watching this video, I'll check out the comments. Don't hesitate. The most important thing in my experience as a mortgage professional, clients do not ask questions. And I don't understand that. This is often the biggest purchase you are ever going to make in your life. And the mortgage is the biggest loan or your biggest obligation that you have. So make sure you ask the basic questions. I'm going to cover a few things in this video, like what is a mortgage and how it works, break down your payment, what's included in that. I'm going to discuss the different types of mortgages, ARMs, adjustable rate mortgages versus fixed rate mortgages. We'll talk about your interest rate versus your APR. And finally, we'll end it on the amortization schedule and how that works. And if there are other things that you want to know about on your mortgage, drop them in the comments and I will do my best to get back to you with an accurate and timely response. So let's just dive in. Okay, what is a mortgage and how does it work? Well, at the basic level, a mortgage is a loan that you are taking out to purchase a home, a residential property. It's an agreement that you are making with a bank or mortgage lender for a certain amount of time with a certain payment schedule that they are going to lend you money that you're going to use to purchase a property, and you're going to pay them back. And once you pay them back, they are going to release their lien on your home. If you don't make the payments, they're going to reclaim the property. Your home that you're buying is the collateral. And the way to think that how this really works is think of it as leveraged. A mortgage is a tool that you are using to acquire an asset, right? Most people don't have enough cash to purchase the property outright. So what they do is they go to a bank or lender and they go through an application process, a vetting process, and the lender says, you are worthy of this loan. We believe you're going to make the repayment on it, so we're going to lend you this money, and you make payments on it on a certain agreed upon length of time, and once you're done, the loan is paid off and the lien is released. That's it at the end of the day. It's just an agreement that you're making with a bank to pay them back the money that they lent you. Again, you're not the collateral, the home is the collateral. So if you stop making payments, they're not going to garnish your wages, they're not going to throw you in jail, they're going to seize the collateral, the home. So what is in your mortgage payment? Let's talk about that. Again, this is a mortgage basics video, so we're not going to get too into the weeds about mortgage payments and waiving escrows or not waiving escrows. But at the end of the day, there are four things in your mortgage payment. There's the principal and interest. Okay, that's the agreement. That's the amount that you are paying back the bank or mortgage lender. When you sign the agreement for the loan terms, how long you're going to have the loan, how many payments you're going to make, that is what you're agreeing to. That is the portion of the payment that is going towards the loan, the principal and interest. However, there are two other things that are often included in your mortgage payment, and that is your taxes and your insurance. And when I say insurance, I mean homeowner's insurance. Okay, so oftentimes those are going to be collected in your mortgage payment, and when you make your payment each month, they're going to take the T&I, the taxes and insurance, and they're going to put them into an escrow account for you. The escrow account is attached to the mortgage on the property. The way to think about it is a savings account that you have, that its only purpose is to pay your real estate tax bill and your homeowner's insurance bill. So oftentimes you're going to escrow your taxes and insurance. They're going to be part of your mortgage payment, so you're making that PITI, principal, interest, taxes and insurance, every month, and 1/12 of the annual real estate tax bill and your annual insurance bill, homeowner's insurance bill, is being taken from that payment and put into the escrow account. If you ever sell the home or you ever refinance, they're going to close the escrow account and they're going to send you a check for that amount. Your mortgage servicer, if you are escrowing, is going to handle the payments for your taxes and your insurance. That is their job as a servicer, that they're going to be making those payments for you. However, be your own advocate. I can tell you from experience, always make sure that your taxes and your insurance bills are being paid by your servicer. It is your home, and you want to make sure that those things are getting paid. You are working with lenders, and I'm not going to go on a tangent here, but long story short is, be your own advocate, watch your escrow accounts. If you get taxes or insurance bills in the mail, call your servicer up and make sure that they're getting paid. So let's talk about the different types of mortgages now. And really there's just two categories I want to talk about in this video, and that's the adjustable rate mortgage and the fixed rate mortgage. So an adjustable rate mortgage, what we often refer to as an ARM, basically it has a lower interest rate to start for a agreed upon period of time. That could be 1 year, could be up to 10 years. And after that fixed period, that interest rate you have is going to adjust. So you might start off with a lower monthly payment, and then over time, your payment might go up because your interest rate is going up. However, it's not a guarantee that your rate is going to go up. Some cases, some ARMs, you can see the interest rate go down. You really want to make sure you know what you're doing, you know your numbers before you ever get involved with an ARM. It is one of those products that got a really bad name reputation during the housing crisis, but has made a resurgence now with rates being as high as they are. You do see more people getting into ARMs. And it really requires you to have a lending partner, a loan officer that's really going to work with you, not just for the transaction of getting the keys in your hands, closing on the house, but also help you manage the mortgage after closing, checking with you from time to time, especially when that fixed period of time on your ARM is going to be adjusting, to see if it makes sense to refinance into the other type of loan that I'm going to talk about, which is a fixed rate mortgage. And here in the United States, we're pretty fortunate. We've got some great fixed rate products. You can get a fixed rate, which is just that. Your interest rate stays fixed for the life of the loan. And you can do different terms. You can get a 30-year, which is the most common, but you can also get lower than that. You can do a 25, 20, 15, 10-year term as well. Just remember, those payments are fixed. And if you do not make a payment on time, you could be hit with late penalties. And if you miss enough payments, again, they could take the collateral of the mortgage, which is your home. So while people always are interested in looking at those shorter term loan, make sure that you're comfortable and you're able to make those payments before you ever sign the agreement that you're going to be doing a shorter term loan. You could always go with a 30-year fixed option and pay it off faster. Let's talk about the difference between the rate and the APR now. So you are going through this process and you are getting a mortgage loan, and you might see the term APR often. And the difference between the interest rate and the APR is pretty simple. The rate is interest on the loan. That is over the life of the loan. You will also add an additional amount of interest, and that is what your rate is. It's calculating that amount of your interest. Whereas your APR, that's the overall cost of acquiring the loan and the payments you're making over time. All right, so I'm editing this video now, and this section about the rate versus APR got a little bit confusing for me. So pause your screen right now to see the true definition of rate, and pause it to see the definition of APR. All right, back to the video. So you might see someone have a very low interest rate, a very low payment on your mortgage, but their APR might be a few percentage points higher than what the rate is. And that is because perhaps they used points, discount points, or origination points to buy down the interest rate, or perhaps there's mortgage insurance on the loan as well. So the APR is the overall cost over time. It's factoring in those points to buy down the interest rate. It's factoring in certain closing costs that your lender, your settlement company are charging you. So it's really good idea, if you are shopping around, that when you are comparing lenders, don't always focus on what the interest rate is. Okay, look at the APR. You want to make sure you're doing an apples to apples comparison always. And that is one way that the APR comes in handy. It lets you get a better insight about, they might be quoting you the same interest rate as somebody else. However, they're charging more fees, more points, and so their APR might be higher. So when you're shopping around and looking at different lenders or banks to work with, it's a good idea to compare the APRs, not just the interest rate. When you are doing this mortgage, you're setting up a schedule of agreed upon payments. And there is something called an amortization schedule that you're usually given at closing. It is a couple page document. You know, I've been to so many closings where the settlement agent says, let's put this on your fridge and you can cross out every month when you make a payment. You know, it gets a good chuckle. Now, everyone's amortization schedule gets thrown out the window when they pay an additional amount towards the principal. There's some great Excel spreadsheets and online calculators that you can use to get a copy of an amortization schedule. You can kind of plug in your own numbers and see if you add an extra dollar or two towards your principal, how that's going to impact the overall interest that you're paying and the length of time that you have your loan. It is, simply put, you're making a monthly payment that consists of that P&I, that principal and interest. In the beginning of the loan, you are paying more interest than principal. And over time, that starts to change. Usually it's around year 11 on a 30-year fixed mortgage where you'll start to pay more principal than interest, but everyone's different, especially in an environment where interest rates can be volatile. That amount of time it takes you to pay more principal than interest can vary. So you really want to make sure that you get an amortization schedule. Ask your loan officer. It's pretty easy for us to run or provide one of those to you. And it's something that I recommend you really kind of have a good understanding of before getting into a mortgage. It's not like a car loan where you can get ahead of payments. You're going to make this payment every single month. It doesn't matter if you're adding more towards your principal. The next month, you still have to make that same payment that you agreed with the lender. What ends up happening is with the amortization schedule, instead of skipping payments like you can do on some installment loans, you'll just pay it off faster. So if I have a mortgage and I add $100 a month to my payment, I might pay my 30-year fixed mortgage off in 27 years versus 30 years. Now, again, this is a basic video where we're not really getting into the weeds here, but I do have one thing that I want to mention. When you make any sort of additional payment, you want to identify where that is going towards. So if you are paying online, make sure you put that additional payment where you want it. It could go towards principal or it could end up going towards escrow. And you never want to leave it to your servicer to decide what they're going to do with that additional payment. And if you found this video helpful, check out some of my other videos. Check them out. You might find them helpful.